What's going on, everybody? It's Spencer from Gray Capital, and we're talking about interest rates today. Obviously, there's a lot of talk about inflation, interest rates, when are interest rates going to rise? And I would say the number one risk to the economy itself right now would be if interest rates rose dramatically. So that's what we're asking ourselves. Interest rates, you may not have known this, but they're at a 5,000 year low right now. And when things hit a low like that, it begs the question, do you buy the dip? Now, people aren't really buying the dip, although if you're a bond trader, maybe you are, and you don't usually look at it like that. But saying if things are so low, aren't they going to rise again? So that's what we want to get into about where are interest rates, where are they maybe going, where are they not going, the short term, the long term, and then what you should be doing about it right now in this environment of a little bit of uncertainty, but using a little bit of context over the past 5,000 years to kind of chart that course, make some good decisions, at the end of the day, make a little bit of money when you are investing. All right, let's get into it. But first, if you're not subscribed to the Gray Capital YouTube channel, do that right away. Give this video a like, and I would love to hear your opinion, whether you agree, disagree, think we are smart, or we are idiots. So let us know below in the comments. And again, if you like this material, after you subscribe, hop on over to graycapitalllc.com/newsletter, sign up for our free weekly newsletter. Okay, let's go. As I mentioned a second ago, we are at a 5,000 year low in terms of interest rates, going all the way back to 3000 BC, where interest rates were nearly 20% and upwards of 25%. Now that's according to some tablets from Mesopotamia. We obviously don't have that much information dating back 5,000 years ago, but the information that we do have lets us know that if you wanted to have an interest to do something, for a loan, typically backed by some kind of metal, it's usually gold, the interest rate would be upwards of about 20%. While that is extremely high, and it's really an all-time high, we've never seen rates exactly that high since, although we got close into the mid-70s. That kind of sets a high watermark. And then looking at the 5,000 years after those highs and 3000 BC, we can start to build a trend and a trajectory. And what we really start to see is a natural movement of interest rates going lower. Since that point in time, certainly there are many oscillations, transients, and certain periods of volatility. But if we really take a step back, we see lower interest rates over time, edging their way down, and then typically there'll be some kind of crisis, some kind of policy decision that might add some volatility, increased interest rates, but still over time, you saw rates go lower and lower. So again, there's this natural phenomenon and trajectory of lower interest rates for longer, but you can see that it's not a straight line like most things just in life, in the universe. There's volatility, there are transient events, and there's oscillations. Things move up and things move down. There's somewhat reversion to the mean, but that mean moves as time moves forward, and on the actual numbers becomes lower as the actual figures interest rates are lower themselves. So you can see, again, going all the way back to 3000 BC, we're talking Mesopotamia times, 25% interest rates. Really, this line is continuing a relatively linear trajectory if you wanted to average it out and draw a trend line, but there's obviously some major fluctuations. And this is the key point, that these are mostly driven by policy decisions. It's not really markets that are driving these rates. Markets are driving these rates lower as technology develops, as just risk decreases in society, and as society develops and matures and develops, interest rates become lower. We become into a more mature economy and mature society. But that doesn't mean that governments and society isn't going to try to get in the way and screw things up. And so you see spikes. If you go back into even a more detailed map than this, this chart is just some quick freehand, but you'll see specific policy announcements, whether that was, outlawing usury, or when you could all of a sudden lend again, those rates fluctuated significantly. So whether that was, commercial volatility in the Middle and Dark Ages, or whether that was mercantilism and the Age of Exploration kind of in the, early, 1700s, 1800s that caused, a certain amount of volatility, but the expansion and growing of commerce with all these, new worlds, new lands, new areas to expand to and grow into, that certainly affects interest rates in general. But, and again, what can't be ignored, and what most people think back to, and it's in the rearview mirror, is the crisis, the inflation crisis in the 70s, brought on by OPEC and the oil embargo kind of in the mid 70s. But it led to a certain psychology of business owners and consumers assuming that there was inflation in the market, expecting inflation, which is the real main driver of inflation, is that psychology. So assuming prices are going to go up, you want to spend your money as opposed to sitting on it and letting it decrease in value. So spending increases, consumption increases, investment increases. In general, that's a higher velocity of transactions, higher velocity of money, and that drives inflation. If you don't believe there's that much inflation, you're not going to be taking on that type of behavior. And that spiral is what led to this spike in interest rates, which, we would say, and I feel like it is more common to hear, that the low interest rates today are unheard of, and that they are such a unique time in human history. But really, this period in the 1970s, early 80s, that was the unique time in history. That was the aberration. As opposed to this, we were basically in kind of a 3 to 5% range, for the vast majority of, civilized, human society. We're in this 3 to 5% range. We're not in the 10 to 15, almost 20% range like we saw in the 70s. That being said, many investors, especially, baby boomers or older Gen Xers, the mid 70s and 80s wasn't that long ago. I was born in the, in the mid 80s. And so that possibility of seeing interest rates go to those high levels seems like much more of a possibility than if you were looking in the context of, again, the past 5,000 years of human history. I would have to beg the question, what is the probability of a second, 5,000 year event that had only happened one time in history? What's the likelihood of that happening, again, in a short time span, relative to, again, the entire history of economics and society? Now you can say, the rate of change and progress and human development, we've taken, the US dollar off the gold standard, we are using Keynesian economics and modern monetary theory, and this vast acceleration of new economics is allowing for a new opportunity to see a spike like this. But I think that's a lot of speculation to really make that jump. And so what we're really trying to get at here is the trend is your friend. And so what we know is that there's a possibility for rates to be higher at some point in the short to medium term. But what we can be fairly certain about, given 5,000 years of history, is that over the long term, rates will remain lower, it will stay lower, and eventually move lower. And my prediction is that within the next 10 years, maybe within the next 5 years, we will see negative interest rates in the United States. There's already tens of trillions of sovereign debt that is at a negative interest rate. It's only a matter of time until the US Federal Reserve also incorporates negative interest rates, again, continuing this multi-millennia trend downward. There's no reason that zero is the bottom, since so many other central banks have already gone to this 0 point. Okay, point number 2, when we're talking about interest rates, and you'll probably heard this saying before, and it comes back to the first point, but don't fight the Fed. You don't want to get in the way. A lot of people learned this lesson last year in 2020 during the pandemic. As the economy had been, the stock market was crashing, we were going to lockdown, seemed like the end of the world, coronavirus, the whole story. Once the Fed stepped in and the federal government stepped in, there was a backstop. And the Fed was going to support markets with significant amount of liquidity, low interest rates, and they were going to push the economy forward. And there were a lot of people taking short positions even when they did, and they got burned significantly. When the Fed steps in, they have a massive ability to move markets, to inject liquidity, to buy securities. They have a blank checkbook, and with the amount of deflationary forces at that given time, having the entire economy shut off, they had that ammunition to make significant moves. And they did, and they essentially saved the economy, at least for the short term. So you don't want to get in the way of the Federal Reserve. And so that's why it's important to monitor what the Fed says, what are they projecting. That's why we cover quite a few of the Fed's meetings, their notes, the beige book, etc. Because if you know what the playbook for the Federal Reserve is, you can have a little bit of a crystal ball into what the economy is going to look like, or at least in the Fed's view, what they would like it to look like in the next couple of years. And they have the power to more or less make that happen. Now, can the Fed overshoot? Can they screw things up? 100%. They've done it in the past, and they will do it again. But I would say the majority of times, the Fed has the ability to move things the way that they want. So what does the Fed want to do right now? What is the Fed's playbook? Well, the Fed's playbook is to keep rates lower, pushing for an average inflation target of around 2%. Again, that's an average over an unknown period. And we've been basically operating below 2% for quite some time, really over the past decade. So it is going to take quite a few years being over 2% to finally hit that 2% average. There's even talk at the Federal Reserve to move that target average inflation rate from 2% to 3%, and that would allow the economy to run even hotter. Now, why are they doing this? The Fed has two clear mandates: stable prices and maximize employment. So prices, they're somewhat stable, although they are increasing, at a decent clip. But employment is much more of the focus on the Federal Reserve. They want to see the employment rate and the labor participation rate really as high as possible. And they're willing to let the economy run hotter for longer in order to maximize employment. Now, they may be tapering some of the purchasing of bonds and other securities, but the idea is they're going to keep that shorter term Fed funds rate lower for longer. And so if we know that the Fed is going to keep the Fed funds rate, which is the shortest term interest rate, as low as possible, they're going to allow actual growth to run hotter. And so you're going to have lower interest rates, but hotter growth. If we know that is the landscape that we're going to find ourselves in over the next 3-5 years, we can take certain actions and take advantage of those market conditions. Okay, we have a good idea of, kind of the history of interest rates and debt. We have a good idea of what the Federal Reserve's playbook is going to look like, more or less, at least what they're telling us publicly. What about the federal government? I mean, the Federal Reserve has a lot of power, but still, the federal government, it's the largest superpower in the world. The entire global economy is based on the U.S. dollar, so it's very important what the U.S. government does. But right now, the U.S. government, the U.S. sovereign debt, as of today, is $29 trillion. $29 trillion, a significant increase even from the last year in 2020 and 2019. The interest payments alone on $29 trillion of debt, or at least in 2020, we paid about $385 billion just to pay the interest on the debt. And that was still with essentially almost record low interest rates. Now, if interest rates were to rise significantly, the U.S. government would have a very difficult time servicing that $29 trillion worth of debt. And of course, this number doesn't include the new infrastructure bill that's working through Congress, the $3.5 trillion of additional spending that's working its way through Congress, all of the other spending that is going to happen over the next couple of years. That number is not going down anytime soon. But as a quick example, we've got a lot more debt. Right at $385 billion, that equals about 1.6% of the U.S.'s GDP. Well, that's a huge number. Fast forward back to the 70s, if I had this map here, when interest rates were significantly higher, the U.S. Interest payments as a percentage of GDP was closer to 3.6%. So even though our debt, which was much smaller in the 70s than it is compared to today, that debt compared to GDP was much higher due to the interest rates. And that's why Paul Volcker, when he was chairman of the Federal Reserve, his main task was to fight inflation. It wasn't just for the everyday consumers, although that certainly was a problem. The US government, we couldn't service our debt, and deficits were a major problem. If the government can't spend money, if they can't deficit spend, they can't do the things that they want, their hands are tied, they're shackled. But if they've got essentially a blank check, free money in the terms of 0% interest rates or extremely low interest rates, the government can do that much more and has that much more ability to, accomplish whatever they want to accomplish, whether it be good or bad, depending on, whatever your political ideology might be. So because of that, the US government is going to do anything they can to make sure that rates are lower for longer. And even though that the Federal Reserve is technically a private organization that has some slight oversight from Congress, there's a lot of, talking, a lot of the same individuals kind of go back and forth, and everyone's kind of on the same page, is that lower rates, basically free money, cheap debt, without too much growth, is the kind of the Goldilocks balance that they're trying to achieve. And again, the US government doesn't have much choice because they cannot afford to pay any more interest on essentially $30 trillion in debt. Okay, so if you have been able to kind of read between the lines of what I'm saying, I believe that interest rates are going to stay lower for longer. And we may see some blips. There could be some policy decisions that could raise rates in the short term or even the medium term. But for the most part, I think rates are going to stay significantly low and even go lower over a long period of time. I even believe that we're going to see negative interest rates, certainly in my lifetime, I think in the next 5 to 10 years. So what do you do about it? We're going to see low interest rates, but we might see some moderate growth. And even though it's counterintuitive, we may see higher rates of inflation, but still low interest rates, while the Fed says, let's run hotter, let's get as many people employed as possible, even though the purchasing power of those wages may be going down slightly. So if you are going to do one thing, now this isn't technically investment advice, financial advice, legal advice, consult your own advisors, but I would accumulate as much debt, low interest rate debt as possible, only if it is backed by hard cash flowing assets. Let me say that again. Accumulate as much debt as possible, only if it is backed by hard cash flowing assets. So I'm not talking about racking up credit card debt. I'm not talking about racking up debt to go buy a car or something that's not going to throw off any cash flow or something that's intangible. I'm talking about buying typically a physical asset that is throwing off cash. It's typically has some type of operating revenue. And the perfect example for this would be multifamily apartments. Multifamily apartments are hard assets. They're real physical pieces of property, and they also generate significant amount of cash flow. Now, why multifamily is kind of in this real unique sweet spot right now in our current environment where we're seeing low interest rates but relatively high levels of growth is we can lock in this incredibly cheap debt. Again, it's essentially free money, but our top line revenue, the money that's coming in the cash flow, it is going to be able to track inflation, essentially on a day-to-day basis because we're signing new leases at these apartments every single day. So if we see a spike of inflation, our cost of debt, stays down here, and actually the value of that debt decreases. Inflation is destroying the value of that debt, while the value of our asset starts to grow significantly because our top line revenue growth, that rental revenue that tracks and actually outpaces inflation, is increasing the value of that underlying asset due to the way income producing properties are valued. Usually typically by a cap rate. You take your net operating income and you divide it by your cap rate. Okay, now just to recap, the trend is your friend. We have seen interest rates decline over 5,000 years. Doesn't mean that what comes up will not come down. There's not reversion to the mean. There's not oscillations, but there's also linear trajectory. Second, don't fight the Fed. Listen to the Fed. And understand the playbook. You want to be flowing upstream. You want to be going down with the right direction of current. You don't want to be paddling upstream. It's gonna make your life so much easier as opposed to trying to time something. And again, train as your friend, the idea that you can time the bottom of a 5,000 year trend is ridiculous. Okay, number 3, US government debt. Again, it's $29 trillion right now. It's gonna be well over $30 trillion in 2022. The US government cannot afford to pay any more interest on its debt. It would be unaffordable. They don't wanna spend a dollar more interest than they would like to. And then the fourth and final of what you should do, the action that you can take right now, again, is to allocate yourself to hard cash flowing assets and take out as much accretive debt as possible. Now, there's bad debt, there's unaccretive debt, higher interest rates that you need to pay, bad terms, bad lenders. So you need to be smart about this. And one way is to partner with a group that is putting the projects together, like a real estate syndication firm that's finding the deals, putting the debt in place, even guaranteeing that debt. So you don't have to be on the hook for the debt, but your investment is leveraged by that same debt at these incredibly low interest rates. But you are going to have the full advantage of hedging against future inflation, seeing revenue rise, value appreciation, while having that debt absolutely destroyed by inflation. So again, buy hard cash flowing assets with as much debt as you can. Make sure they're good investments, they're cash flowing, it's the right debt, the right lender. Be smart about it. But if you can do this, you're going to be on the path to build an incredible amount of wealth. All right, appreciate it. That's all we've got for you today. My name is Spencer Gray. I'm the president of Gray Capital. Gray Capital, we're a real estate investment and asset management firm based out of Indianapolis, Indiana. We're putting together multifamily investment opportunities all the time for accredited investors. So hop on over to graycapitalllc.com to check us out. We've got a free newsletter you can sign up for while you are there. But be sure to like this video, give the Gray Capital YouTube channel a subscription. And again, tell us we're full of BS or you like what we said below in the comments. We look forward to doing another one of these and hearing from you soon. All right, thanks.